right. Hey, everybody. It's Mike Banner, and welcome to another episode of 62 Who Knew. Very excited about today's guest. Of course, this is our first episode with my new glasses, so I expect it to go viral. We could have 1 million views. If you like the glasses, please let me know at mbanner62 Who Knew. If you don't like the glasses, keep that shit to yourself. I don't really want to hear it. I mean, I don't need bad news. Anyway,
without handle the truth.
That's right. Thank you. You can't handle the truth. Without further ado, let me introduce someone that was on the 62 Who Knew television show twice, and this is his first time back on the 62 Who Knew podcast. He's a friend. He's a confidant, someone I trust. He's a nationally known financial planner and advisor. I'm going to read a fraction of his bio, because he has so many qualifications that it borderline staggering. So bear with me, Tunde. I'm going to read just a fraction of what you bring to the table. Mr. Tunde Ogunlana is the founder of Family Wealth Advisor. As a family wealth advisor, Tunde focuses on servicing clients in all areas of their financial lives. In doing so, the first step is orchestrating the team of experts that will be instrumental in helping ensure the family's vision is carried out. And Tunde's team is staggering. We will put up his website during or after the episode. The team that he works with is staggering. These professionals may include financial planners, accountants, attorneys, business consultants, investment portfolio managers, insurance agents, among other business specialists. While leading the coordination of the family's affairs, Tunde's goal is harmony to be maintained across the entire spectrum of issue facing today's families. He is a husband. He is a father. He is active in many, many philanthropic things. Like I said, I don't want to take the whole episode of reading what an incredible human being this is. Tunde, thank you for being at 62 Who Knew again.
Thanks, Mike. It's great to be back.
Cool. Well, we're in an incredibly volatile environment, financial environment. Whether you have a little money to invest, a lot of money to invest, there is fear out there. There's been fear out there, for the better part of 10 years. But the last couple of years since COVID, when we went to sleep in December of 2021 with 2.5% and 3% mortgage rates, and woke up in January of 2022 at 7.25%. Obviously, we've had much higher rates. In the 80s, rates were in the 18s. We've spent many years, decades, double digit, but never has the country gone from 2.5% or 3% to 7 or 7.5% like that. And it had an effect on the economy and on the investment world that we're still feeling 3 years later. People are afraid. Are you seeing that with your national clients? I mean, people are going, Tunde, what do we do? Well, blue chips aren't what they used to be. Nothing is what they used to be.
Yeah, no, I am seeing that. And sorry, I'm just taking some notes here. So yes, I am seeing that. But I would say, if I am honest with myself and you and the audience, I think I've always seen that in my practice, because I have been doing this around 25 years, 24 to be exact. So I entered the business and was fully licensed in 2001 in early '01. So this was as the height of the NASDAQ bubble collapsing was beginning to really take hold. We had not yet had 9/11. We had not yet started 2 wars in the Middle East. A lot of things had not yet happened yet that, this last generation, things that we've all lived through together. So, I'm just actually remembering now, the length of my career, I can say there was never a time dealing with the financial markets where fear wasn't a big motivating factor for both investors as well as, I would say this, the business side of Wall Street, right? Because fear sells. Mm-hmm. So I think that there's kind of a combination of all of that when you deal with financial markets. And why? Because you're dealing with people's money at the end. So it comes from this kind of 30,000 foot societal kind of apparatus of Wall Street, the gears of the system of money and finance and the banking sector and all that. And all of that noise comes down to the individual through media, right? Whether they're watching CNBC or Bloomberg, or they're on their phone getting information, whatever. And so a lot of that, just like we see in other parts of our life, that fear permeates to motivate people to do something, right? Whether it's to vote or whether it's to go buy a product from an advertiser or something. I think that unfortunately, my industry has also recognized that fear helps to sell things and to move people. So I would say that fear has been a part of my career, unfortunately. So
No, I think it's an excellent topic because the
yeah,
truth is, psychologically, emotionally, fear is what motivates everybody. People don't
yeah,
really realize that fear is the number one emotion on the planet. It beats love by anything, and it's so basic. You go to Publix, you go to the supermarket out of fear of running out of food. You stop at the gas station, out of fear of running out of gas. You walk your child to the bus stop so they get on their bus safely.
yeah.
Every loving action, every financial action, everything is based on fear. It's a terrible way to look at it, but it's mentally, emotionally, and psychologically correct.
Well, and think about this, the kind of two emotions that we often hear talked about hand in hand as relates to kind of the almost, if we can call it that lizard brain of the way humans operate, are greed and fear, right? And so I think when we talking about the topic at hand, the financial markets, those two emotions, they can run rampant in that environment.
Yes.
They can be complementary sometimes, they can be contradictory at others. But it's interesting, to think that the financial markets are a place where people do dwell in these type of emotions. I gotta think about why I'm not more depressed in my life dealing with this for 25 years. I never looked at it this way.
62. Yeah. Welcome to 62 Who Knew, the Prozac edition. Yes.
Correct. Yeah. You're enlightening me here. I'm learning a lot about what I've been doing.
Well, a new investor, or I should say a new client, comes to you. They have X amount of dollars, whether it's hundreds of thousands or millions or tens of millions, and they look at you and they go, okay, I need a plan. Either I've never had a financial planner, which most of America has never had a financial planner, and they really do need one. It fits in very well with the 62 Who Knew premise that longer lifespans demands you need a professional team because you're going to be 85 or 90 years old. And if you want your money to last and you want this to be a good last 30 years of your life, you better damn well have a professional on your team. It can't be your brother-in-law that failed the Series 6 test 6 times and now thinks he's an investment broker. You have to have, I guess, different tacks for the investor depending on age and net worth. How do you start that? Okay, nice to meet you. My name is Tunde. I can protect you. Start from there. It's got to have to do with age, assets, risk.
No, so that's a great question. I mean, I don't really have an elevator pitch for that reason, because everyone is different. And that's one thing about being independent and having a more, I would say, smaller, more boutique firm, that we do try and give people that hand holding and that one-on-one feeling. So I guess that would be my commercial, if I can say it that way. But that's why I would say, I mean, Mike, I would talk to you differently than I would talk to a 40-year-old. You know what I mean? That has 2 young kids at home and, they're under 5 years old and thinking about, college and funding and retirement funding, and certain things that you've already been through in life as a parent because you've got grown children, and maybe you're already closer or within the retirement sphere. So our conversation would be much different about that part of your life financially than it would be with someone 40. So I think, but the thing that I think is universal, if I can say it that way, maybe as a better way to answer the question, would be, I think it's risk tolerance and timeline. If we really go 30,000 feet, because when I say you compared to a 40-year-old, really we're talking about timelines based on different goals. Some of them could be parenting goals, because some of them could be retirement, other financial goals, and then risk tolerance is important because I've met people under 40 who hate losing money and it's not appropriate for them to be in the stock market. And I've met people who are in their 80s who are fine with the ups and downs of the stock market, and they totally are comfortable with it and embrace it. So whereas if you just look at kind of financial planning, quote unquote 101, I'm supposed to be telling the younger person they need to be way more aggressive in their stock portfolio, and the older person they shouldn't. But I think part of where I look at financial planning, I would say maybe holistically, and I like the term you used from my website, which I forgot was there, called harmony, having kind of the harmonious situation within the different buckets of our lives. Is, as a financial planner, I'm a believer that the stock market isn't the only place somebody can make some money. Put it that way. Maybe it's one of the easiest ways for us to go passively and be an investor, because you can just open an account online almost anywhere. But if I met someone that's totally uncomfortable with the stock market, but they need to grow their assets over time, we can talk about other things. Art is an asset class, real estate. We can get into coins and stamps if somebody really wants to go, intricate with it. But I'm just making the point that or you can go into investing and buying a franchise or some sort of business, and doing that on the side. And so there's other ways to grow wealth other than just the S&P 500 and the traditional passive investing. My industry would probably not like to hear me say that, because, Wall Street likes to hoard all the money for itself. But the reality is, and that's why I guess this kind of answer, that's why you can't put this into a cookie cutter conversation. It really is about, let me sit down with you, let me get to know you, let me get to know what you have going on, not only from a balance sheet standpoint, but in here, an emotional standpoint, your psychology, who you are, you as a human being. And both of those two, as an advisor, if we can marry the human part with the financial part of a person, then we can get a complete picture. And that's why it's a teamwork, really, because it's our job as the advisor to know that we should do that. It's also the client's job to be transparent with us and let us know what they have going on. Because, I'm sure I'm not the only advisor to deal with this, where clients have things going on and, you're working with someone for 6 months or a year, and all of a sudden they tell you about this whole other thing they have going on, or something like that. And it's like, well, okay, you didn't disclose that to me. And so, and had I known that, maybe I would have advised you differently in one way or another. So, hopefully that's an answer that is salient.
You've spent years building equity in your home, and now it's time to let that equity work for you. The fractional sale of your home equity lets you access the cash you need without taking on additional debt. It is a game-changing tool to help fund retirement, cover healthcare costs, or simply enhance your lifestyle. No monthly payments, no interest, just financial freedom. Turn your biggest asset into your greatest retirement ally through the power of fractional home equity. To learn more about this, go to www.62whoknew.com and check on the Chief's link.
Are you turning 65? Well, if so, the most important decision in your life right now is to determine which Medicare plan you need to be on for your unique changes in life. Are you still working? You on your employer's plan? How about being a snowbird? If so, you need to speak to a Medicare consultant who can help you with your needs. I'm Diane Daniels, and I'm the CEO of Medicare Nation. Go to www.62whoknew.com and click on the Medicare Nation tab. I will give you a free consultation to make sure we find the right plan for your unique needs.
Do you find in the last decade or so that people are a little more afraid of the stock market? I mean, you've been doing this 25 years. I like your honesty. You've always dealt with certain fear. I know I personally have more of a fear of Wall Street, since the Great Recession of, 2008 through 2013, when the balloon burst. I have a little bit more fear of Wall Street than I ever have.
So yes, I would say this. That's a very good question, because it's got me remembering again. So I'll share a few things. And I think things are cyclical in this way. And I do think I'm a big believer in a term that I didn't invent, but, the term living memory. I think that there is, we may be re-experiencing certain experiences from the 1930s today, because we lack leaders with the living memory of the 1930s, right? Like, meaning the way that we see the world going. I think that part of the reason why we got into the financial aid crisis, only one part, I know that there's a lot going into an ecosystem like the American economy, but one reason why we may have had the collapse of 2008 was there was no more living memory from the 1929 crash, at least people alive that were old enough to really understand what was going on back then. I mean, you could have been 100 years old, but you would have only been 10 years old in 1929 or whatever.
Right.
So what I'm saying is the repeal of the Glass-Steagall Act 10 years prior to the 2008 crash in 1998. Remember, the Glass-Steagall Act was a law created in the early 30s after the crash of 29, which separated banks from investment banks, from traditional wirehouse brokerages and insurance companies. And so, it's understandable that 10 years after that law is repealed and all these companies are allowed to go back and play games again, that we have the second largest collapse in American history. Now, since then, thankfully, we've had things like the Basel Accords, the Dodd-Frank, certain regulatory means that have been put in place that from 2010 or so till today, the banking sector in the United States and globally has relatively been very healthy.
Yes.
And we saw that when we had the pressure in 2023 of the FTX collapse and the potential of First Republic Bank going down and all that, and Silicon Valley Bank. And the fact that it was just contained to those banks and didn't spread like it did after Lehman, to me was a big testament that, yes, the system has learned how to work with this new infrastructure. But my comment was just saying that living memory is important. And the reason I bring that up is I remember when I started on my career in 2001, I had met and dealt with some older people who themselves were maybe in their 80s. So that means they would have been born maybe in the late 19 teens or early 1920s. And they were the old timers that only bought CDs. And the reason when you start talking to them, right, it would because they were young people during the Great Depression. They saw their parents lose everything. They were taught by the older generations back then that the stock market was bad. It was something that could hurt you. And they never trusted it again. And so that's why I just bring this up to say, and that's one reason why I love history, because it gives us perspective that this isn't like you asked about the last decade. Yeah, I see a lot of that and I want to address it. But it's just like, if we think about it, this isn't the first time that people have been scared of the financial markets. I mean, I'm glad that we didn't live in the 1930s after the 1929 crash. That seems to be much more painful than anything we've ever experienced. So that's why I would say, and that's why it's kind of jogging my memory, this conversation, that the fear has always been there, I think, especially at an individual level. Some people make money, some people lose money, boom or bust. But here's what I would say. And I apologize to your producer for having to go a little bit in this direction. But I do think that the fear that I've seen in the last decade parallels the proliferation of, let me see how I can put this, more aggressive.
He's being careful.
Yeah, I gotta, like political bias in the media and partisanship. Right. The more that we become hyper-partisan as a country, the more I see people worried about if the other side is in charge. But I don't just get into that with some of these clients because their emotion is more on the person, not the system. And so, It is what it is. And that's not my job to be, I feel like it's not my job to talk about that stuff with clients. My job is to be a steward of their money. So that's why it's, but what I would say, Mike, is that it saddens me a bit because I've been doing this as long as I have. And I would say it's in this last 10 years, really since I would say the 2020 period, that it's gotten like this. Where it's like, if someone's in office, they don't want to have a part of this country, meaning that the client will tell me, I don't want to participate anymore in the economy. And it's like, oh, okay, hold on. It didn't used to be like this, right? Like,
no, it never used to be like this. So, it's kind of incredible.
Yeah. So I feel like, I feel like it's the encroachment of the political biases in people that I've seen more in the last decade that has led to fears about whether the economy or the markets that are different from just the fear of the markets. You know what I mean? It's not like, we're in a recessionary environment, so now I'm worried. It's like, no, this guy's in office, so I'm worried. I was like, well, I don't remember that in 2005 or 2009, like those kind of things. It was more like, all right, the system is the system, and whatever's going on in the economy is what I'm going to worry about. And so
I agree. I absolutely agree. And now we have a variable the last 10 years, maybe a little longer, that no generation has ever dealt with. And cryptocurrency, the thing that you can't see, can't touch. And for the first, and I'm a big believer in crypto, but for the first 5 years, every time an expert explained to me what cryptocurrency was, I think I knew less than before the conversation when they try to explain it to me. I'm a big believer in it. I want to get your opinion. I also know that as an investment broker and dealer, you have a limit of what you can say about it because it's not regulated like your industry is. So I know you have to give us a 20,000 or 30,000 or maybe even a 50,000 foot view of that. But cryptocurrency, talk to me about it.
Yeah, so clearly it is part of, I would say, the ecosystem of economics and finance these days. It's still something that I think it has been up until, I think we're changing that now, literally, as in this period that we're talking now. But it was considered something on the fringe initially. Believe it or not, my son, who will be 27, when he was 13, they used to use Bitcoin as a currency on a game he played on the computer called RuneScape. And it was $11 a coin back then. And he told me, Dad, they're talking about this is going to be an investment and people are going to buy it, this and that. And I looked at him and I said, man, no one's ever going to buy that crap. And here I am, still working.
Yes, and here you are. Yes.
Had I put $1,000 of my own money at $11 a coin, I would maybe not be working right now. So
that's right.
That's why I say that to fall on my own sword in public here, and with all humility to say, yeah, I was a non-believer that crypto would catch kind of traction and be considered serious. And here we are. We have now laws written in that are starting the process of legitimizing cryptocurrency into the banking and financial system and giving it some sort of regulatory framework. One reason why I am limited in how I can talk about crypto due to my securities licenses and how we are able to discuss it with clients or offer it at all, is because as of right now, today, it's still not settled yet whether cryptocurrency is a commodity or is it a security. And I mean, I'm getting a bit wonky now. So for people that aren't familiar with these terms, that might seem like a simple kind of, well, it doesn't really matter. It's, it's already crypto. We all know what it is, all that. But when you're talking about the law, which is what regulation is, it's very important because think about it. Commodity is something like oil, gold, pork bellies, orange futures, all that kind of stuff. Those are commodities, things that we use and consume like that, right? But a security is something like a share of stock in a corporation, or maybe a note that says that, Mike, I owe you money because you lent me money through me issuing you a bond, right? Those have much different legal frameworks. What if I default on the debt? What's your recourse? That's going to be different than if I don't show up, on my container ship with a container ship full of oranges, right? So if we don't even know from a legal and regulatory standpoint whether a cryptocurrency is a commodity or a security yet, then guys like me are prevented from really dealing with it, right? But that's why I said just in the past, this year in 2025, just in the past month or two, there's been a lot of guidance from, our leadership as a nation in terms of crypto, and the Congress has actually put some things in action. We're very early, so that's why I'm not even going to speak too much on it because
that's right.
The legislation, I believe, just passed like 2-3 weeks ago. And I think like most things, there's a lot of information in there and people are trying to work out, okay, what are the details? How's it going to look? This and that. But I would say this, it all looks positive for crypto in terms of that there is becoming some regulatory framework around it. And my attitude has been that crypto is where stocks were in the 1920s. Securities in the 1920s were highly unregulated. And you had a bunch of pump and dump schemes. You had a lot of things that you saw happen in crypto prior to like right now, right? What, like I already mentioned on an earlier comment about FTX from Sam Bankman-Fried, but we know that he was the poster child, like Bernie Madoff was a poster child of Ponzi schemes. But remember, here in South Florida, we had Scott Rothstein. There was a guy down at University of Miami that had an $800 million Ponzi scheme, I remember, in the early 2000s. So, Bernie Madoff wasn't the only guy in Florida doing some dirty stuff, right?
Some bad
And I
stuff,
feel like,
yeah.
I feel like Sam Bankman-Fried is an example of that. He was the headline guy, like Bernie Madoff was the headline, but there are a lot of people doing a lot of shady stuff with crypto. And I have family members and friends who have had their wallets stolen, literally have told me they've watched their money go down while they're looking at it and they just can't
Oh
do
my God.
anything. And so when you think about it, after the crash of 1929, the 1930s became when the regulatory framework that we've enjoyed our whole lives in the securities world was developed. You got the Securities Act of 1933, the Securities Exchange Act of 1934, finishing up, I would say, with the Investment Company Act of 1940, which created mutual funds. There's obviously been legislation after that, but I feel like that kind of decade of the 1930s is when the United States really cleaned up securities and regular. I mean, think about what I just said, the Securities Exchange Act of 1934. So before 1934, we actually didn't regulate exchanges. There was no laws, no federal laws about what do you do with money and people's stocks and all this stuff. How do you keep it safe, and what's a custodian's role and versus the broker dealer or whatever. So this is what's happening now with crypto, is that crypto went through its infancy phase. Some people made huge amounts of money like they did in the 1920s with stocks, and some people got hurt. A lot of people got hurt like they did in the 1920s with stocks. And now that it's still here and people seem to want it, the system is finally saying, you know what, all right, now we got to make it something that is safer for the general public to use and something that can be tracked, and we have some sort of regulations and rules around it. So, yeah, I would assume the rest of this decade will look like the 1930s for securities, where we're just finishing out this regulation.
That's the best analogy I've ever heard. I've never heard anybody put it that way. That
I saved it just for you.
Thank you. You heard it here first, which that and my new glasses is why we're going to go viral on this particular episode. No, that analogy is staggering, that crypto is the stock market and security market right after the Great Depression. Now we're going to get control. I love that. Let's talk about some easier stuff, because again, even though I'm familiar with your practice and I'm familiar with your website, I always go on, hours or the day before my show to look at my guest stuff. And you do have an incredible team. You have, for lack of better terms, a bench with such depth, putting it in the NBA, vernacular there. So let's talk about.
I'm gonna say, as long as I was thinking, because I started thinking about the Harlem Globetrotters. That's why I'm laughing. I'm thinking, let me not be Curly Neal.
No, he was amazing. Are you kidding
I know
me?
he was.
But okay,
as long as we're not the Ross, as long as we're not the Washington Generals, let's just put it that way.
Yes,
I'll be good.
Well, we
So go ahead. Sorry.
No, that's okay. And just for 10 seconds to go, I always thought Meadowlark Lemon. I mean, we're going so far off topic.
Yeah. Now
only people above the age of 50 years old are going to understand what the hell we're talking about.
This might be like over age 70 for Meadowlark Lemon, man. That's an old one.
He was superhuman. He should have been wearing a cape. The things that he could do, the shots that he made over his head from mid-court, the twisting in midair, that motivated Dr. J and Michael Jordan. This man was superhuman. And, of course, the Harlem Globetrotters are still great, but they're not Curly McNeil. And they're not that generation. To me, all right, we went off tap, but we're not editing that out, Mr. Producer. Leave it in.
That.
That'll make it in. What's the biggest threat to your retirement savings? It's not the stock market. It's the cost of long-term care, home care, assisted living, or nursing facilities can drain your life savings in just a few short years. That's why long-term care insurance isn't a luxury. It's a necessity. It protects your assets, preserves your independence, and gives your family peace of mind. Don't leave your future to chance. Plan ahead. Protect what you've worked a lifetime to build with long-term care insurance. For more information, go to www.62whoknew.com and click on the long-term care insurance link. When it comes to building a rock-solid retirement plan, life insurance and annuities are two of the smartest tools you can use. Life insurance protects your loved ones and can even build tax-advantaged cash value. Annuities provide guaranteed income you can't outlive. Together, they create a powerful foundation for security, growth, and peace of mind. Don't just hope your retirement plan works. Plan it with certainty. Ask how life insurance and annuities can shape your financial future today. Go to www.62whoknew.com, click on the life insurance and annuity link, and start planning for your financial future today. Let's talk about easy stuff, because I know you have experts on your bench, on your team. Long-term care insurance, which again, the myth of only the wealthy can afford it, which is not true. It's too expensive. It's out of most of America's price range. Not true. That's one of my big tickle buttons in life.
Yeah.
Again, especially because we have a 50-50 chance of making it to 90. And depending on what statistic you look at or what survey, there's a 70 to 75% chance that you or your husband, you or your wife, you or your partner are going to have a long-term care event. And in today's world, it's not going to cost tens of thousands of dollars. It's going to cost hundreds of thousands of dollars. So tell me I know your personal opinion, but tell me, and of course we're both friends with the Yoda of the reverse mortgage world, Peter Geldwax. How do you look to your people in their 50s and 60s that are still healthy enough to get long-term care insurance but don't have it, whether it's traditional or a hybrid product, life insurance, annuity with a long-term care rider? How do you look at that from a personal level?
That's a great question, man, because that industry has changed a lot over my career. And I was going to say a joke that, long-term care could potentially cost someone so much that I'm glad that I'm not going to have that problem because of the amount of whiskey and bourbon I've already drank in my life. That I'm probably not making it till 90. My wife might have that problem, but not me. So
that train has left the station, you're saying?
Yeah, exactly. I think I got maybe 30 years left. I'm good. But no, so here's the thing. I'm trying to think where to start. So because long-term care is one of the newer forms of insurance, if I can say it that way. Mm-hmm. Life insurance in its modern form don't kill me because I think the year was 1744, but it was somewhere around there in the 1700s that life insurance was began by a group of monks in Scotland, I think it was, and it was the whole widows and orphans thing, right? How do you take care of
monks?
These people in society who have lost the breadwinner, and so obviously it became a business, and by the 1800s, life insurance was a kind of a regular industry, sector of the economy in England, America, a lot of the advanced economies in the world. Disability insurance, annuities, things like that all have been around for 100 years at least. And then you get into things like property and casualty, like insuring homes and cars and things like that. And my point is the system, in terms of the people who manage the actuarial risk around these events within the insurance companies, who make the decisions on how much to charge for premiums and all that, because they're looking at all this data. There's a lot of data for things like that, going back for decades, if not a century or two. What happened with long-term care, I believe, was created initially in the late 80s, began to get sold and get on the market with individuals in the 80s, but became much more popular and discussed by advisors and known by the public by the early 2000s. That's why I said my career, starting when I started, long-term care was also in its infancy. So what happened and what I saw, for example, was long-term care was underpriced for a long time, because what happened was the industry was using the morbidity tables and mortality tables from the 1980 census. And between 1980 and the year 2000, medical and scientific research and all this stuff had advanced to the point where life expectancy had increased a lot. And here's a stat that I checked just before we got on the show because I wanted to make sure I was correct. Do you know what the life expectancy of the average person in the United States was in the year 1900?
Oh, I would guess 50-something? I don't know.
No, it's a younger, 47.
Wow.
That was the
You're
average.
Starting to have fun. And
so my point is, and today I think it's around 79 or 80. So
what's funny is it's 79 or 80 counting infant births and things such as that, the entire census. The thing that staggers me is if you make it to 65 in this country,
Yeah.
there are an incredible amount of surveys out there that say you have a 50-50 shot of making it to 90.
Yeah,
if you
I've
made
seen
it
that
to-
kind of stuff too.
Isn't that
and you're right.
incredible?
Yeah, and so and obviously we got to acknowledge that the 1900 information would have included from births to deaths. But the idea is that, to your point, generally people weren't walking around thinking about what is going to happen with them when they're in their 70s, 80s, and 90s. There just wasn't if you were 30 or 40 in the United States in the year 1900, you didn't think you were going to make it to 100. And so fast forward now, and that's why I said between 1980 and 2000, life expectancy in this country jumped a bit more, right? And so what happened is you had an industry that was pricing a product based on 1980 information, and in the early 2000s, that information and data had changed a lot, but the pricing had not. So I'll give you an example. I had a client that we first met in 2007. He had already suffered a stroke and had a speech impediment. He was at the time in his tipping into his late 70s, and he had bought a long-term care policy from the insurance carrier CNA in the year 2000, and he was paying, I think, about $4,000 a year in premium, right? He ended up having some issue, I think around 2010, where I just remember it was bad. He had fell, then he had to have this thing, his intestines exploded, so he had to have the colonoscopy bag, and he was like in bad shape. He ended up being on 24-hour long-term care from 2010 to 2016 when he passed away. And he had a $4,000 a month benefit. You see what I'm saying? So here's a guy, and I'm just going to pull my calculator out to do my math correctly. So if I can say that it cost $48,000 a year for 6 years, that's $288,000 that the insurance carrier spent on his care, right?
Yeah.
But they collected from him $4,000 a year, I think, for 9 years.
They lost.
So they
on that
collected $36,000 in premium from him, and they paid out $288,000. So
They
what
lost
happened?
$250,000.
Yeah. So if you multiply that out by hundreds of thousands, if not millions of insurance customers, the long-term care industry was totally underwater by the early 2000s, And so companies like MetLife and GE, which used to be leaders in that space, Genworth used to have a product. It was a GE subsidiary, and MetLife had a very strong product. They actually got out of the business completely. And so what you had then was around 2015 going forward, companies redeveloping the product and creating what you had alluded to, which was hybrid products, where it's a life insurance policy that can deliver you long-term care style benefits. But if you don't use it or you pass away, someone else still gets either a death benefit or the cash value you built or whatever.
Death benefit.
Correct. As opposed to when I was starting in the business, the only choice was a traditional annual premium policy. And if someone was paying $5,000 a year and they were going to pay that for 20 years, that would be $100,000 out of their estate. And if they drop dead without ever using long-term care, that money is not coming back. So it made the conversation about long-term care, spending all that money on that premium, a little bit more difficult than it is today, when someone can just maybe have some money accumulated already and just move a certain amount of money to this quote unquote long-term care bucket, which might be in a hybrid product. And that money can sit there. And if they want to use it for long-term care one day, if they need it, it's there. They could even say one day, hey, maybe after 10, 15 years, if I don't feel I have this risk anymore, I can take the money out and do something else. And if I drop dead without ever having needed long-term care, because, a lot of people die without using those services, then at least I know that money I moved to the side, either that exact dollar amount or maybe with a slight multiplier on it, is going to go to my beneficiaries. So,
And tax-free.
yeah, correct. So I think that, the conversation about long-term care has been made easier because of some of those product changes. And I think that most people that I deal with, at least, I'd say anecdotal here on that one, unfortunately have dealt with some sort of long-term care issue in their family. Like they've either had a parent they've watched go through some stuff, or an uncle or an aunt, or just somebody they know of. And so I think it's a little bit easier of a conversation now. And that's probably a function of what we just talked about, right? If you think about now, these are the people born in a time when we all lived longer, as opposed to,
That's right.
when I was starting my career, I'm dealing with older people that grew up at a time when people didn't live that long, and they may not have had those experiences when they were kids.
Yeah, I mean, it's what got me.
Hopefully,
addicted.
there was an answer in there somewhere, because I know
There was. No,
you asked a question like 15 minutes ago.
No, it's okay. No, that was a great answer, because the truth of the matter is I became addicted to long-term care insurance, when I was taking care of my father the last 6 months of his life. And we didn't have it. And life was good, and he had great care, and yada, yada, yada. I was so naive, talking 20 years ago. And I said to all full-time nursing people that were in the house, how do normal people take care of this? How does everyday Americans, afford 24-hour care? And I remember them looking at me.
They don't.
I didn't know Peter Gelbwachs at the time, and saying, you know what? If you couldn't afford it, your father would be in a facility that you would not like very much.
Yeah.
And then it was a few years later that I met Peter Gelbwachs and became addicted to long-term care insurance. I think Peter's first clients, I think their name was Fred and Wilmer. I'm not sure. I think that was Peter's first long-term care clients.
Did they have a son named Bam Bam?
Yeah.
Okay, I'm just checking.
Yeah. All right, let's go from. So we.
And real quick, let me
agreed.
finish this on long-term care though. I'll just say this on a serious note from a professional hat, just for people listening too, because I used to look at long-term care as more of a healthcare play. Because the mind, you think about what you just said, right? In-home nurses coming in to help somebody, and it involves their deterioration, medically and all that kind of stuff. So I used to think of it like that, and that also had me not taking it, I'd say, in the way that I take it now, a little bit more serious as a financial protection tool. So the way I've learned to describe long-term care to clients is like an airbag in a car. I tell people, if you're going to go hit that tree over there at full speed, you're going to have an accident. Your car is going to get damaged. The difference is the airbag is to prevent you from flying through the windshield. And so I say, think of long-term care as a financial airbag. Because if you're going to get into a long-term care need, like health-wise or physically, that's going to happen. Just like if you go full on into the tree, you're going to hit it, and you're going to damage your car. The difference is, though, with long-term care, you're not flying out of the windshield, as my analogy financially. Because what I tell people sometimes is, let's say hypothetically someone did a good job saving some money. I mean, we have some clients that they can self-insure. You're worth over $30-40 million. You don't have to worry about spending an extra $100,000-200,000 a year once, if something like this happens. But for the person that isn't, and that has their single family home, did a great job on their 401k, has a pension, but not really a bunch of assets outside of that. What I tell them is, look, this beautiful IRA or this account that you save, did all this hard work saving up, that you really want to go to your kids and grandkids, no one's going to let you die on the street. So if you get into a situation where you need in-home care, your kids are going to make sure you get care. The difference is it's going to come out of that nest egg that you think you're leaving to them. So I describe the long-term care insurance as like an airbag. It's a cushion. It's not going to prevent you from getting into a long-term care situation, just like an airbag's not preventing you from getting in an accident. But in the event it happens, then you're cushioning the blow, because if you had done a great job and you're 65 and you saved $1 million, or let's say you're 75 and you have $1 million to your name and you're drawing, $5,000 a month in retirement or something, and you got your Social Security and your pension, and all that adds up to a nice income for you. Well, what's going to happen if you have an in-home nurse now, and in a market like ours in South Florida, that's costing them $70,000 to $100,000 a year for someone to show up every day. You know what I mean? And so if you got $1 million that you're drawing $60,000 a year from, and now you got to take an extra $70,000 to $100,000 a year on top of that, that money's not going to be there for the next generation. So what I talk about is, let the long-term care be that cushion, be that airbag, drawing out that extra amount so that your assets can continue to function the way you want them and can meet the goals, whether it's you buying something or leaving them to your kids. So that's all that I wanted to get out just as we finish.
No, I'm glad you. And you said two things that that sparked me because, another one of my mentors that I've learned so much from, says that it took him decades to look at, you said you look at long-term care insurance a little differently right now. And one of the things he's very well known for saying is it's not just health insurance, it's wealth insurance.
Yeah, that's a great point.
I've always liked that quote. And then the other thing that always drives me crazy.
I'm going to steal that one.
He's right. And you know the person who said it, so I'm sure he'll be okay with you stealing it. And the other thing that drives me crazy as a novice, not the person with all the license and levels of expertise that you have, but they're writing about this for the last 5 years everywhere, is when somebody says, not when a client, but when a financial planner says to their client, you can self-insure. And I'm one of those people that thinks there is no such thing as self-insuring. You're self-funding. Don't fool yourself into thinking you're self-insuring. Only an insurance company can waylay your risk for a fraction of the dollars of whether it's car insurance, life insurance, any insurance.
Yeah.
They're insuring you a fraction of the dollars to pay the big man. But it drives me crazy when a certified financial planner says to a client, you're wealthy enough, you can self-insure. You're wealthy enough, you can self-fund. I'm, again, not with anywhere of your level of expertise. That drives me crazy. I don't know why.
You've got an
Somebody
expertise.
taught me that.
You've got an expertise in the English language. That's what it is. You're not incorrect in your statement. That is the correct way to say it.
Sometimes I act like I'm educated. Yes, I do. All right. Well, as always, the time has just flown by.
Yeah.
I want to remind people that if you are interested, and you should be interested in long-term care insurance or annuities, life insurance, or anything that's going to make the last 30 years of your life the best 30 years of your life, go to www.62whoknew. Check on the long-term care insurance link, and I will connect you with someone with this level of expertise to take care of you and your family. So, Tunde, as always, such a pleasure.
It's funny you say it, Mike. As much as I just sound like I know, whenever we have clients that do long-term care, it's not me putting it together. I still go to an expert because there's a lot of nuances.
That's the way it should be.
Yeah, I get it at 30,000 feet, and I understand the different.
Yeah, me too.
But when it comes to case by case and which carrier is delivering the best for this or that issue, we're concerned. There's definitely we need the experts coming in.
That seems to be becoming an analogy of my life. I get everything at 30,000 feet. I'm not sure what I get anymore at 3 or 4 feet.
I'm starting to feel the same. I think it's probably as we're getting older.
Yeah, I don't understand. Everything's from 30,000 feet. I want to come on your podcast and talk about how longer lifespans is affecting everyone. I know we've talked about that. And, of course, you're welcome to come back. I hope you're going to be a regular
definitely.
on the 62 Who Knew podcast.
Anything that I can contribute and help with, I'm happy to. So,
all righty. Thank you so much, my friend. Thank you, everybody.
Definitely.
Remember the 3 words that I always end with, that if you want your life to be perfect, I mean perfect. Remember these 3 words. Buy my book. Go to Amazon and look for A Gift from My Father. Those are the 3 words. These are the rules to live by to make your life good. So go to Amazon and buy A Gift from My Father. Thank you, everybody. Next week, RE/MAX introduces itself to 62 Who Knew, something we have been waiting for months, and we are very, very excited about giving full real estate services to all our viewers, all our subscribers, not just in America, but in every country, 110 countries to be exact, that RE/MAX services people buying and selling real estate. So next week, RE/MAX comes to 62 Who Knew. Thank you, everybody. Have a great week. Thank you, my friend Tunde.
Thanks, Mike.